Before you file your income tax return this year, let me ask you one simple question. Does your tax return tell the same story the income tax department already has about you? Because if it doesn't, that's how so many NRIs end up with a tax notice. Not because they hid income, not because they actually committed a fraud, but because their return didn't match with their bank, their tenant, a mutual fund, or even the buyer of their flat had already reported against their PAN. These are honest people who paid every single rupee they owed, and a notice still landed months later. By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC, and one of India's top wealth management firm before launching my own startup. And this is Finicky, where I simplify money the same way I practice it. In this video, I'll show you the filing mistakes that quietly trigger these notices, the incomes NRIs often forget to report, and a simple 3-step checklist that can save you months of unnecessary stress. So, let's start with the very first question almost every NRI gets wrong before they have opened the filing portal. Do you even need to file a return in India at all? For most people, the answer feels obvious: no tax to pay, no need to file the return. That's not always true. The basic rule is simple. If your taxable income in India crosses the basic exemption limit, filing is mandatory. But here's where many NRIs get into trouble. Even if your tax is zero or your income is below the limit, there's still a strong reason to file if you have made certain high value transactions during the year, or buying a property in India, making a large mutual fund investments, or depositing significant amounts into your NRO account. The law doesn't force you to file just because of these transactions, but every one of them is reported independently to the department. So by the time you sit down to file, it often already knows they happened. Skipping filing on a property bought with overseas savings, and months later the department sees the purchase against your PAN with no return explaining it, that mismatch alone can trigger a notice. Now let's get to the timing of filing the return. If your only income this year is salary, rent, or capital gains with no business income, your due date this year is 31st July 2026. With business or professional income, you get until 31st August 2026. Miss it and you can file a belated return up to 31st December 2026, but with a late fee and a hidden cost. If you have made capital losses, filing late means you lose the right to carry them forward against future gains. So the rule: if your income crosses the exemption limit, file on time. If it doesn't, you have had a reportable transactions, file a nil return anyway. It costs nothing but explains what the department already knows and essentially avoids a notice later. There is a single entry on your return that changes almost every rule after it: your residential status. It's one of the most misunderstood ideas amongst NRIs. Many assume it depends on an OCI card, the passport they carry, or simply the years they spent abroad. It doesn't. For income tax, residential status is decided by the number of days you spend in India in the relevant financial year, along with certain statutory conditions. And based on that, you fall into one of the 3 categories: resident, non-resident, or resident but not ordinary resident, which is also called as RNOR. Each is taxed differently, especially on foreign incomes, and the margins are finer than people think. A common trigger is spending around 182 days in India in a year. So even a trip home that runs a little long can actually tip you from one status to another and change what you're actually taxed on. But there isn't one clean number that fits everyone. The tests carry conditions, some looking back over your earlier years in India, so don't just eyeball it. Count your days properly for the year you are filing. Here's where it actually goes wrong. Someone lives abroad for years, their status changes without them noticing, but they keep filing exactly as before. I've seen people file as resident when they're actually qualified as NRIs, and they reverse too. And the consequences are bigger than most people expect. And once you're treated as a resident, foreign income can become taxable and disclosures of your foreign assets can become mandatory, all because one field was filed in wrong. The fix is very simple. Don't assume your status. Calculate it every financial year. Check your days, confirm whether you are an NRI or RNOR, and if it's changed, file according to your correct status, not the one you carried over from last year. Once that's right, you would think the hard part is over. But surprisingly, many valid returns become defective because of something far more ordinary: the wrong ITR form that many NRIs choose. For many NRIs, ITR 1 is generally not the right form, even when the income looks simple. The correct one depends on your income types, how many properties you own, whether you have capital gains, whether you have business gains, or foreign assets, and your residential status. I've actually seen families file together for years. One spouse becomes an NRI, the accountant reuses the last year's form out of routine, and the return is treated as defective. Accurate numbers, correct tax, wrong format. Completely avoidable, right? So, before filing, check that every family member is on the correct form for their status and the income. Accurate numbers can't rescue a return filed in the wrong format. Now, before we get into how the department actually checks your return against its own records, a small ask while I have you. If this video is helping you, do hit the like button and also the hi button right next to it if you've seen one. That genuinely helps this kind of video reach more NRIs who are quietly worried about the exact same things you are. And here's something bigger. In my last few videos, I floated an idea, a podcast with our community where real NRIs come on and share their real situations they're actually stuck in. The kinds of problems thousands of NRIs are facing right now: taxes, RNOR status, compliance, where should the investment should actually sit, property back home, when to finally move back for good. And say the goal here is to not talk about it, but it's actually to sit down together and solve as much as possible in that one conversation. Your response to that idea was genuinely encouraging, so my team is already working on making it happen. If you would like to be part of that conversation streamed right here on the channel, there's a Google form in the description. Let me know your story and my team will reach out to you. That being said, let's get back to the video. So let's say you have done everything right, decided to file, confirmed your status, picked the correct form, and many people assume the department simply trusts what they enter. It doesn't. Before your return is even processed, it actually matches against information already in the government's database. And that's where most notices actually begin. Through the year, banks report your interest, employers report salaries, mutual fund reports transactions, property registrar report purchases and sales, and TDS is recorded separately. All of it comes together in 3 documents: your AIS, your TIS, and your Form 26 years. If you file from memory or from your own records alone, you risk a mismatch. A bank reports interest you would have actually forgotten, TDS shown up differently, a transaction is actually reported wrong, and the department doesn't need proof you hid income. A difference between your return and what it already has is often enough to raise a query. So here's a step that catches most of it. Download your AIS, your TIS, and your Form 26AS and compare every entry against your bank statements, investment reports, and capital gain statements. If something in your AIS looks wrong, don't ignore it. Use the feedback mechanism to correct the record before you actually file. Obviously, if you do all of this last minute, it becomes too late. And once people start comparing, a pattern shows up. The same income stream gets missed again and again. Start with bank interest because all accounts are treated the same. Interest on an NRO account is taxable in India. Many assume that because the bank already deducts TDS, there's nothing left to do. Not so. TDS is only the tax collected in advance. It doesn't replace reporting that income. See, NRI and FCNR interest, on the other hand, is generally exempt for eligible NRIs, but exempt doesn't mean you live it out. Banks still report it, so disclose it under the exempt income schedule. In short, NRO interest as taxable, NRI and FCNR interest as exempt. The second mistake is assuming TDS settles everything. It doesn't. It's an advance payment, not your final liability. Sell a property and the buyer may deduct TDS calculated on the entire sale value. But your actual tax is only the capital gain, and after the cost of acquisition and any eligible exemptions. Say you sell an apartment for 1 crore that you originally bought for 80 lakhs. TDS can be actually deducted on the entire full 1 crore, but your real gain is only 20 lakhs, and that's what you're actually taxed on. The gap between the two can be several lakhs sitting with the government as a refund you have to actively claim back. So skipping the return because tax has already been deducted can cost you real money. Next, rental income. If you own a property in India, the rent is taxable here no matter where you live. A common mistake is not reporting it or reporting only the net after expenses or TDS. Disclose the gross rent first, then claim the deductions. And make sure your tenant knows you are an NRI. Otherwise, they deduct TDS under resident landlord rules, creating reconciliation headaches later. Then there's capital gains. Actually, many believe that if you reinvest under Section 54 or another exemption, they need not report the transaction because the tax becomes nil. That's not how it actually works. Again, declare the full capital gains first, then claim the exemption in the relevant schedule. The exemption reduces the tax, it doesn't remove the duty to disclose. And if you have made losses you want to carry forward, the return has to be on time or you lose that benefit. So even after you have reported everything, one more assumption causes problems. I live abroad, so the double taxation avoidance agreement automatically protects me. It doesn't. Treaty benefits need paperwork. Typically, you will need to establish that you're genuinely a tax resident of the other country with tax residency certificate or TRC, what we call. And because the TRC often doesn't carry all the details that the Indian tax authorities want, you'll usually have to file a short self-declaration under Form 41, which is also old Form 10F. The exact requirements depends on your country of residence. I've covered this in much more detail in another video. The link should be somewhere here. Without the documents, treaty relief is hard to defend if your return is questioned. So get the certificate and keep it on record. And finally, something that surprises even honest taxpayers is large money transfers. People say the money is clean, it's my overseas salary, why would anyone question it? Because legitimacy and documentation aren't the same thing. Transfer a large sum into your NRO account and the bank reports it. 2 years later, you'll be asked to explain the source, and if you have changed jobs, switched banks, or lost the records, a one-line answer becomes a long paperwork exercise. So, build one habit. Every significant transfer to India, save 3 things in a folder: the foreign bank statement showing the debit, your salary slip or income proof, and the foreign inward remittance certificate if that's issued, which is also called the FIRCs. Build your own record trail while the documents are still easy to find. So, if there's one idea you have to walk away with, it's this. Stop asking how much tax do I owe, start asking does my return match with what the income tax department already has? Because that's what most notices are really about. Not hidden income, just simple mismatches. I put together a detailed note along with do's and don'ts and a checklist. If you want that, comment ITR and I'll share that with you. Now, it may sound tedious, but before you file the return for this year, run 3-step check. Download your AIS, TIS and Form 26AS. Cross-check every income stream, transaction and TDS entry against your draft return and confirm your residential status, bank account, classification and ITR form all matches your situation for this year. Get those 3 right and you'll remove the vast majority of what triggers unnecessary notices from the income tax department. If you found this genuinely useful, share this with another NRI friend who needs to know this. And also comment if you have any questions. I'll try to respond to every single one of them. That's it from me. I'm Nikhil. Subscribe to learn how to make your finances less tricky, and that will also help you to not miss the next one. Thanks for watching and I'll see you in the next one.